Opendoor stock is currently trading at $5.53 during the intraday session on Thursday, April 3, 2026, marking a slight decline of 0.89% from the previous close. While that headline number might seem like just another quiet day for a real estate platform, there is a much deeper story happening beneath the surface of the ticker tape. While most investors are fixated on the volatile swings of the housing market, a massive shift in institutional positioning has been quietly taking place over the last few trading hours. Large-scale block trades are hitting the tape, suggesting that big money managers aren't just watching the price, they are recalculating the entire valuation of the iBuying sector as we head into a new month. The general expectation for Opendoor has always been tied to interest rates. The narrative is simple. When rates go up, the housing market freezes, and Opendoor loses. When rates go down, the market thaws, and the stock should fly. But here is the reality that the market is beginning to wake up to. Opendoor is no longer just a bet on the Federal Reserve. It has transformed its inventory management to a point where it can potentially sustain margins even in a high-rate environment. The old Opendoor would have been crushed by the current lack of inventory, but the new version, often referred to as Opendoor 2.0, is showing a resilience that short sellers didn't see coming. We are seeing a divergence where the stock is starting to decouple from the broader real estate sector, which usually moves in lockstep with mortgage applications. When you look at the recent daily swings, the volume is what tells the real story. We've seen several sessions where the buying pressure at the $5.20 support level was relentless. This isn't retail traders on a mobile app. This looks like institutional accumulation. Sector momentum in the proptech space has been sluggish, yet Opendoor is attracting fresh capital because it's effectively the last man standing in the large-scale iBuying business. While competitors folded or retreated, Opendoor leaned into its algorithm. Macroeconomic pressures remain a concern, but the recent earnings reactions suggest that the market is finally rewarding the company for narrowing its losses rather than punishing it for not being instantly profitable. The volatility we see today is the sound of a stock trying to find its new floor after years of being treated like a distressed asset. Institutional activity has spiked recently, with several major funds increasing their stakes. This is often a sign that the smart friend in the room knows something the general public is still debating. If you look at the Interactive Brokers platform or check the latest filings on the Fidelity mobile app, you'll notice that the ownership structure is becoming more concentrated. This reduces the float and makes the stock more susceptible to explosive moves when positive news hits. The market is currently pricing in a lot of fear, but the reality of the balance sheet suggests a much longer runway than the bears are willing to admit. It's a classic tension between the public's memory of the 2022 housing slump and the 2026 reality of a leaner, more tech-driven operation. Beyond the immediate price action, let's talk about what this company actually does and how it makes a living. At its core, Opendoor is an algorithm that buys houses. They provide a service where a homeowner can get a cash offer in minutes, skip the showings, and close on their own schedule. They make their profit on the spread, the difference between what they buy the house for and what they sell it for, plus a service fee. In the early days, they were aggressive and overpaid for inventory. Today, the business model has shifted toward a more conservative, asset-light approach. They are focusing on partnerships and ancillaries like title and escrow services to boost the revenue per home. This shift is critical because it moves them away from being a pure-play real estate flipper and closer to being a vertically integrated transaction platform. Past performance was marred by the sudden spike in interest rates, which left them holding thousands of homes that were losing value every day. They had to clear that inventory at a loss, which led to the massive drawdowns we saw in previous years. But that legacy inventory is gone. Every home on the books now was bought using a more sophisticated pricing model that accounts for the current market stagnation. This is why the latest reports show improving unit economics even though the total volume of homes sold is lower than its peak. They are prioritizing quality over quantity, which is exactly what you want to see from a company trying to prove its sustainability to Wall Street. Looking forward, the catalysts are lining up in an interesting way. The biggest opportunity lies in the eventual normalization of the housing market. There is a massive amount of deferred demand, people who want to move but are waiting for a reason to break their low-interest mortgage handcuffs. When that dam breaks, the volume of transactions will explode, and Opendoor's infrastructure is already scaled to handle it. The risk, of course, is that the housing market stays frozen longer than their cash reserves last. But with recent capital raises and debt restructuring, they've bought themselves the time they need to reach that break-even point. It's a high-stakes game of chicken with the macroeconomy. Expectations for the upcoming months are guarded, but if they can show even a small surprise in their acquisition numbers or a slight beat in their margin per home, the stock could easily re-rate. Many investors are using tools like Schwab Intelligent Portfolios or various investing sites to diversify, but Opendoor remains a concentrated bet on the future of how homes are traded.
It's not for the faint of heart, but for those who understand the storytelling psychology of the stock, the current price represents a reality that is far more stable than the market's narrative suggests. Comment below how many shares of Opendoor stock you currently hold, or if you're waiting for a specific price target to enter. If you are managing your own individual brokerage account or using something like the Robinhood app for your online investment, you know that timing in these small cap tech names is everything. The liquidity provided by the Robinhood stock trading community often adds a layer of retail momentum that can push these stocks past their technical resistance levels. We've seen this happen with SoFi Invest and other fintech names, where a loyal user base creates a floor for the stock. Opendoor is starting to develop that same kind of following. People who have used the service and see the value in the list with Opendoor product are becoming the very investors who support the stock during downturns. Whether you're looking for investment help through Fidelity Wealth Management or you're a fan of self-investing via interactive brokers, the key is to look past the daily noise. The $5.53 price point is a snapshot of current sentiment, but it doesn't reflect the long-term value of the data Opendoor has collected over the last decade. They have a more granular understanding of neighborhood-level pricing than almost any other entity in the country. In a world where data is the new oil, that proprietary pricing engine is an asset that doesn't show up on a standard balance sheet. It's the hidden reality that could eventually lead to an acquisition or a dominant market position. As we wrap this up, the central insight is clear. Opendoor is no longer the reckless iBuyer of 2021. It has matured into a disciplined tech platform that is navigating a historically difficult real estate market with surprising precision. The gap between what people think of the stock, a risky, money-losing flip, and the reality of its improving unit economics is where the opportunity lies. Those who are active in online investing and use platforms like SoFi Trading or the Fidelity Opal app should be watching the volume levels at these current prices. The tension between expectation and reality is at an all-time high. And usually when the market is this divided, the eventual resolution is a powerful move in one direction. The authority in this space belongs to those who can see the structural changes before they are reflected in the quarterly earnings. By focusing on the acquisition cohorts and the speed of inventory turnover, you get a clearer picture of the company's health than by just staring at the stock chart. Opendoor has built a machine designed for a new version of the American dream, one that is mobile, fast, and digital. Whether the market is ready to price that in today or 6 months from now is the only real question left. For now, the intraday movement shows a market that is hesitant but observant, waiting for the next catalyst to prove that the transformation is permanent. Maintain that sense of depth in your own analysis, and don't let the short-term swings distract you from the massive shift in how we buy and sell the world's largest asset class. Keeping an eye on the broader landscape is essential for any serious investor. Whether you're browsing investing sites for the latest trends or checking your Fidelity iRace for long-term growth, the real estate sector is a fundamental pillar of the economy. Opendoor's role in that pillar is evolving from a disruptor to an essential utility. The cash now, more later model they've introduced is a perfect example of how they are adapting to seller needs in a high-rate environment. It's about providing options, and in a stagnant market, options are the most valuable currency there is. This is why the stock continues to hold interest despite the broader headwinds facing the sector. The reality of the situation is that Opendoor is fighting an uphill battle against perception, but the internal metrics are moving in the right direction. The shift toward a less capital-intensive model is the right move at the right time. By leveraging partnerships and focusing on higher margin services, they are building a more sustainable path to profitability. This is the kind of insight that helps you stay ahead of the curve when everyone else is just looking at the surface-level data. Stay focused on the reality, manage your expectations, and keep a close watch on how the market reacts to the next set of operational benchmarks. The story of Opendoor is far from over, and the next few chapters are likely to be the most decisive ones yet in its history as a public company. Authority in investing comes from this kind of granular understanding and the ability to distinguish between a temporary setback and a structural flaw. Opendoor seems to be proving that its previous setbacks were indeed temporary. Disclaimer. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.